The financial world is replete with stories of meteoric rises, but few capture the imagination quite like that of Dan Zanger, a man who transformed a modest $10,775 into an astonishing $18 million in just 18 months. His journey from a swimming pool builder to a record-setting stock market trader is not merely a tale of luck, but a testament to a meticulously developed and rigorously applied trading formula. This extraordinary feat, achieved between June 1998 and December 1999, saw Zanger set a world record for the highest percentage return in a personal portfolio over a single year, an incredible 29,000%. The question that continues to intrigue and inspire traders across the globe is, what exactly was this one formula that powered such an unparalleled financial success, and how can its principles be understood and potentially applied by today's market participants? At the core of Dan Zanger's formula lies a deep-seated philosophy and a highly disciplined approach to the markets. His intellectual journey began with an intensive study of William J. O'Neill's seminal works, particularly his renowned CANSLIM methodology. Zanger spent countless hours immersed in O'Neill's teachings, meticulously dissecting market patterns and honing his skills in reading stock charts. This foundational knowledge was not simply adopted but refined and personalized over many years, culminating in a unique trading system that suited his temperament and market observations. He understood that while O'Neill provided the framework, true mastery came from relentless practice and adaptation. Zanger's strategy is built upon three fundamental pillars, each indispensable to his success. The first pillar is an almost exclusive reliance on pure technical analysis. He places unwavering trust in the information conveyed by stock charts, trading volumes, and price dynamics, viewing them as the most reliable indicators of market behavior. For Zanger, the charts tell the story, revealing the footprints of institutional money and the collective psychology of market participants. He believes that fundamental analysis, while important for identifying strong companies, does not dictate the precise timing of entries and exits, which is where technical analysis excels. The second pillar is momentum trading, a strategy that focuses on identifying and riding the strongest upward trends. Zanger specifically targets stocks that are demonstrating powerful upward momentum, often driven by significant institutional capital flows. He understands that large institutional investors, with their massive capital, are the true movers of the market, and by following their lead, individual traders can position themselves for substantial gains. This approach requires a keen eye for nascent trends and the courage to enter positions when many others might hesitate, fearing that the stock has already moved too much. Finally, the third and perhaps most critical pillar is extraordinary discipline. Zanger's success was not just about finding the right stocks or patterns. It was about the unwavering adherence to a predetermined set of rules and a highly systematic approach to every single trade. This discipline minimized emotional influence, which is often the downfall of many traders. He understood that emotions like greed and fear can cloud judgment, leading to impulsive decisions that deviate from a sound trading plan. His discipline extended to both entry and exit points, ensuring that he consistently followed his system without exception. The detailed components of Zanger's formula reveal a comprehensive strategy for navigating the stock market. His process begins with meticulous stock selection, aiming to identify market leaders with the potential for explosive growth. He primarily seeks out high-momentum stocks, those that are on the cusp of breaking out to new historical or 52-week highs. These are the companies that are already showing strength and are likely to continue their upward trajectory, drawing in more buyers. This focus ensures he is always trading in the direction of the prevailing trend, rather than trying to pick bottoms or tops. Beyond technical momentum, Zanger also pays attention to strong fundamental indicators. He gravitates towards companies exhibiting impressive earnings growth, often looking for increases of 50% or more year over year. Significant sales growth is another crucial factor, indicating a healthy and expanding business. He also favors companies with innovative products or services that give them a competitive edge and a dominant position within their respective industries. This combination of strong fundamentals and technical momentum creates a powerful synergy, confirming that the stock's price action is backed by real business strength. A key technical filter Zanger employs is high relative strength. He looks for stocks that are outperforming the broader market, consistently setting new relative strength highs. This metric compares a stock's performance against the overall market, indicating its leadership status. A stock with high relative strength demonstrates that it is in strong demand, even during periods of market weakness. Furthermore, Zanger concentrates his efforts on leading sectors, focusing on stocks within the strongest and most promising industry groups. This sector-based approach ensures he is always fishing in the most fertile waters, where market leadership and growth potential are concentrated. Mastery of graphical patterns serves as the roadmap for Zanger, guiding him to identify precise entry and exit points. He meticulously studies these patterns, understanding that they represent the collective behavior of buyers and sellers over time. Among the key continuation patterns he utilizes, the cup and handle is paramount. This pattern typically forms a U-shaped base, resembling a teacup, followed by a smaller, shallower consolidation known as the handle. The handle formation often precedes a significant price breakout, indicating that the stock is consolidating before its next major move. Zanger waits patiently for the price to break above the resistance level of the handle, signaling a high probability entry point. Another set of crucial continuation patterns includes flags and pennants. These are short-term consolidation patterns that emerge after a rapid, almost vertical price movement, often referred to as the flagpole. Flags are typically rectangular, while pennants are triangular. Both indicate a brief pause in buying or selling pressure before the trend continues in the original direction. Zanger understands that these patterns represent a temporary breather for the stock, allowing it to digest recent gains before resuming its upward climb. They are particularly useful for identifying opportunities to join an established trend after a quick burst of price action. Ascending triangles are also a vital part of Zanger's pattern repertoire. These formations are characterized by a horizontal resistance level at the top and a series of higher lows, which creates an ascending trend line at the bottom. This pattern demonstrates increasing buying pressure that is pushing the price closer to the resistance level, suggesting an imminent breakout. The repeated testing of the resistance level combined with rising lows indicates that sellers are losing control and buyers are gaining strength. Zanger monitors these patterns closely, anticipating a powerful move once the horizontal resistance is decisively breached. Finally, flat bases represent periods of sideways movement where a stock trades within a tight price range. These consolidation phases often precede significant breakouts, especially when the stock has already experienced a strong upward trend. A flat base allows the stock to consolidate its gains, shake out weaker holders, and build energy for the next leg up. Zanger looks for these bases to be relatively shallow and tight, indicating strong underlying demand. The longer and tighter the base, the more powerful the subsequent breakout can be as pent-up demand is released. Beyond continuation patterns, Zanger also developed a keen eye for reversal patterns, which are equally important for timely exits. Recognizing formations like head and shoulders, double and triple tops bottoms, rounding tops bottoms, and bearish and bullish wedges allows him to exit positions before significant losses occur, or to avoid entering a trade on the wrong side of a major trend change. These patterns signal a shift in market sentiment and are critical for protecting capital. While his primary focus was on riding up trends, knowing when to get out was just as vital as knowing when to get in. The role of trading volume is absolutely critical in Zanger's formula, serving as the fuel that drives stock movements. For him, volume is not merely a secondary indicator. It is a primary confirmation tool that validates or negates price action. He believes that a price move, especially a breakout without corresponding high volume, is like a car without gasoline. It simply won't go far. Volume provides the necessary evidence of institutional interest and commitment, which is essential for sustaining a new trend. Zanger places immense importance on volume as a confirmation of a breakout. When a stock breaks out of a well-formed chart pattern, such as a cup and handle or a flat base, it must be accompanied by a significant surge in trading volume. This surge indicates that large institutional investors are actively buying the stock, providing the necessary liquidity and buying pressure to propel the price higher. Without this institutional support, a breakout is highly susceptible to failure, often resulting in a false breakout where the price quickly reverses. Quantitatively, Zanger demands that the volume on the day of a breakout be at least 50%, and ideally several 100%, above the stock's average 20-day or 50-day volume. This specific requirement ensures that he is only entering trades where there is undeniable evidence of strong institutional participation. A 50% increase is a good starting point, but truly explosive moves are often preceded by volume spikes of 100%, 200%, or even more. This dramatic increase signals a powerful shift in demand for the stock. Conversely, Zanger views a breakout on low volume as a critical red flag. Such a move is considered a false signal and should either be ignored entirely or, if a position has already been taken, quickly exited. Low volume suggests a lack of institutional conviction and indicates that the price increase is likely not sustainable. It could be due to speculative retail buying or simply a lack of sellers, rather than strong, committed institutional purchasing. Adhering to this volume confirmation rule significantly reduces the probability of entering losing trades. The rules for entry are precise, designed to identify the exact X marks the spot for purchasing a stock. Zanger's primary entry strategy is to buy on a breakout. This means entering a position when the stock's price decisively crosses above a trend line or a key resistance level of a recognized chart pattern. He waits for the stock to demonstrate its strength before committing capital, rather than trying to anticipate the breakout. This patient approach minimizes the risk of entering too early and getting caught in further consolidation or a false move. A crucial aspect of his entry discipline is the strict adherence to a price limit. He never buys a stock more than 5% above its confirmed breakout point. This rule is designed to prevent chasing stocks that have already run up significantly, which increases the risk of buying at an inflated price and immediately facing a pullback. Entering too far above the breakout point reduces the potential reward and increases the immediate downside risk. The 5% rule provides a clear boundary, ensuring entries are made at optimal risk-reward levels. To ensure consistency and remove emotional bias from the entry process, Zanger often utilizes automation. He places stop-buy orders just slightly above the identified breakout point. This allows for automatic entry into the stock as soon as the breakout is confirmed by price action and volume, without the need for constant manual monitoring. Automated orders help execute trades precisely at the desired levels, preventing hesitation or delayed reactions that can lead to missed opportunities or suboptimal entries. This systematic approach is a hallmark of his disciplined trading style. Managing risk and establishing clear exit rules are paramount in Zanger's formula, serving to protect capital and lock in profits. He employs extremely strict stop-loss orders, understanding that limiting losses is the first rule of successful trading. An action is taken to sell a stock very quickly if it reverses back below its breakout point, often within a tight range of 5 to 7% below the purchase or breakout price. Sometimes he would even use a dollar-based stop, selling if the stock dropped just $1 or $2 below his entry, depending on the stock's volatility and price. This rapid exit minimizes the impact of losing trades on the overall portfolio. Zanger also rigorously limits the risk on any single trade, never risking more than 1% of his total portfolio capital on one position. This rule is crucial for portfolio protection, ensuring that even a series of losing trades will not severely impair the overall capital. By keeping individual trade risks small, he avoids the catastrophic losses that can result from overconcentration or excessive risk-taking. This conservative approach to risk management allows him to stay in the game and continue to capitalize on winning opportunities. Partial profit-taking is another key component of his exit strategy. When a stock advances by 15 to 20% from its breakout point, Zanger often sells 20 to 30% of his position. This strategy serves multiple purposes. It locks in some profits, reduces the overall risk exposure to that particular stock, and provides capital that can be redeployed into other promising opportunities. It's a way of taking some money off the table while still allowing the remaining portion of the position to run further, capitalizing on potentially larger moves. A core tenet of his philosophy is to let winners run, cut losers quickly. This means holding on to the strongest performing stocks for as long as they continue to demonstrate upward momentum and fundamental strength. Conversely, stocks that stop moving higher, show signs of sluggishness, or violate their stop-loss levels are sold without hesitation. This philosophy prevents small losses from turning into large ones and maximizes the gains from successful trades, allowing the portfolio to grow exponentially through compounding. To protect profits on the remaining portion of his winning positions, Zanger utilizes trailing stops. These are dynamic stop-loss orders that adjust upwards as the stock's price increases. Often, these trailing stops are based on short-term moving averages, such as the 10-day or 20-day exponential moving average. If the stock breaks below this moving average, it signals a potential trend reversal or a significant loss of momentum, prompting an exit. Trailing stops ensure that a substantial portion of accumulated gains is preserved, even if the stock eventually reverses its trend. The aggressive yet controlled approach to position sizing and the judicious use of leverage were also critical elements in Zanger's formula, allowing for exponential portfolio growth. In the initial stages of a major market uptrend, when he was just starting to build his positions, he often traded with a concentrated portfolio, sometimes even focusing on a single stock that showed the most promising setup. This focused approach allowed him to maximize the impact of his early winning trades, ensuring that even a small capital base could generate significant returns. Initially, he might use a moderate amount of credit leverage, such as 2 to 1, especially when he had high conviction in a particular setup and the overall market trend was favorable. This allowed him to amplify his returns, but it was always done with extreme caution and a deep understanding of the associated risks. As his portfolio grew, his approach to position sizing evolved. He would gradually increase the number of stocks in his portfolio, diversifying his holdings somewhat as his capital expanded. For instance, he might start with 1 or 2 key positions, then expand to 3 stocks until his capital exceeded, for example, $4 million. At the peak of his trading with a multi-million-dollar portfolio, he might hold anywhere from 7 to 8 or a maximum of 12 different stocks. This diversification, while still focused on market leaders, helped spread risk across several promising opportunities. It's important to note a crucial caveat regarding margin. Zanger emphatically advises against using margin or credit leverage until one has fully mastered the intricacies of the market, developed a profound understanding of chart patterns, and, perhaps most importantly, gained complete control over their own emotions. Margin can accelerate gains, but it can also amplify losses with devastating speed if not handled by an experienced and disciplined trader. To fully appreciate the power of Zanger's formula, it is essential to consider its application during the dot-com bubble of the late 1990s. This period provided an extraordinarily favorable market cycle, characterized by explosive growth in technology stocks, creating ideal conditions for his momentum trading strategy. The late 1990s were a time of unprecedented technological innovation and investor exuberance where many companies, particularly in the internet sector, experienced parabolic price increases. This environment was tailor-made for Zanger's approach, which thrives on strong, sustained trends. Zanger's strategy naturally led him to focus intensely on technology stocks, which were at the forefront of this market phenomenon. He concentrated his capital on companies that were demonstrating rapid growth, often revolutionizing their respective industries with new internet-based business models. These were the stocks that were consistently breaking out of patterns with massive volume, attracting significant institutional and retail interest. His ability to identify and ride these leading technology names was a critical factor in his monumental success. The exponential growth of Zanger's portfolio was a direct result of the consistent and highly disciplined application of his formula within this unique market context. Each successful trade, carefully managed for risk and maximized for profit, compounded onto the next. His system allowed him to scale a relatively small initial capital base into millions of dollars, not through a single lucky trade, but through a systematic series of well-executed decisions. The dot-com bubble provided the fertile ground, but Zanger's formula was the engine that harvested its immense potential. Beyond the technical and systematic aspects, the psychology of success formed an invisible yet absolutely decisive element of Zanger's formula. He understood that even the most perfect system is useless without the mental fortitude to execute it flawlessly. Emotional control was paramount. Zanger trained himself to resist the euphoria and irrational exuberance that often accompany winning streaks, preventing him from becoming overconfident or taking undue risks. Equally important was his ability to avoid panic during periods of losses or market corrections, sticking to his stop-loss rules without hesitation, even when it felt uncomfortable. He recognized that the market is designed to prey on human emotions, and mastering these emotions was a prerequisite for long-term success. Continuous learning and adaptation were also central to his psychological edge. The market is a dynamic entity, constantly evolving, and Zanger never stopped studying. He continuously analyzed new market patterns, sought to understand the rotation of capital between different sectors, and closely monitored broader macroeconomic factors that could influence market trends. This commitment to ongoing education ensured that his formula remained relevant and adaptable to changing market conditions. He was not rigid in his thinking, but always open to refining his understanding based on new information and experience. Finally, iron discipline was the bedrock of his psychological framework. Zanger's unwavering adherence to his own trading rules without making exceptions was what truly set him apart. He treated his trading plan as a sacred contract, executing every step with precision and consistency. This meant taking small losses when required, even if it hurt, and letting winners run, even if it felt risky. This steadfast commitment to his system, irrespective of market noise or personal feelings, allowed him to achieve a level of consistency that is rare in the trading world. His discipline was not just a characteristic, it was an integral part of his one formula. The formula that transformed Dan Zanger's modest capital into a fortune offers several fundamental lessons for contemporary traders. The primary takeaways underscore the critical importance of technical analysis, particularly the diligent study of chart patterns and the indispensable role of trading volume as a confirmation tool. These elements provide a clear, objective framework for identifying high-probability trading opportunities. Furthermore, Zanger's story highlights the absolute necessity of robust risk management strategies, including strict stop-loss rules and thoughtful position sizing, which are vital for capital preservation and long-term viability in the markets. At this point in our exploration of trading mastery, it's worth considering a resource that delves deep into the psychological and strategic nuances of market speculation. For those who seek to truly understand the minds of legendary traders and the timeless principles that govern financial markets, Reminiscences of a Stock Operator offers invaluable insights. This new edition of Edwin Lefebvre's classic provides a profound analysis of Jesse Livermore's psychology and strategies, enriched with unique commentaries and chapter-by-chapter breakdowns. It transforms Livermore's historical experiences into practical, actionable lessons for today's traders, bridging the gap between past wisdom and present-day application. If you're ready to gain a deeper understanding of market dynamics and the mindset required for success, this book is an essential read. You can find the link to purchase your copy in the description below this video. Moreover, Zanger's journey powerfully illustrates the paramount significance of psychological resilience and emotional control. The ability to manage fear, greed, and overconfidence is often the differentiating factor between success and failure in the volatile world of trading. His formula teaches that the market is as much a test of character as it is a test of analytical skill. Traders must cultivate a disciplined mindset, capable of executing a plan without being swayed by the inherent emotional pressures of financial speculation. However, it is crucial to acknowledge the importance of context when evaluating Zanger's extraordinary success. The question of whether such a feat can be replicated today requires a nuanced discussion, considering the significant changes in market structure and the unique characteristics of the dot-com bubble period. The late 1990s were marked by an unprecedented surge in specific technology sectors, fueled by widespread speculative fervor and a relatively less regulated environment compared to today. The velocity and magnitude of price movements during that era were exceptional, creating opportunities for exponential gains that may not be as readily available in more mature or efficiently priced markets. Modern markets are characterized by high-frequency trading, algorithmic strategies, and a much larger volume of institutional participants, which can alter price dynamics and pattern reliability. While the fundamental principles of technical analysis and risk management remain timeless, the specific conditions that allowed Zanger's capital to multiply 1,800-fold in such a short period were undoubtedly unique. Therefore, while his methods offer invaluable lessons, traders must adapt them to current market realities, understanding that the exact replication of his specific results might be extraordinarily challenging. The core lessons, however, about discipline, pattern recognition, and risk control are universal and enduring. This comprehensive overview of Dan Zanger's One Formula is designed to encourage traders to delve deeper into its core principles. By studying and thoughtfully applying the key elements of his strategy, from meticulous technical analysis and volume confirmation to stringent risk management and unwavering psychological discipline, aspiring traders can significantly enhance their own development. Zanger's story is not just about making millions. It is about the power of a systematic approach, relentless study, and the mental toughness required to conquer the complexities of the stock market. His legacy serves as a powerful reminder that while market conditions evolve, the fundamental human elements of discipline and continuous learning remain the ultimate drivers of trading success. As we conclude our deep dive into the strategies that propelled Dan Zanger to legendary status, it's clear that understanding market history and the foundational narratives of finance is as crucial as mastering technical indicators. For those who wish to immerse themselves in the rich tapestry of Wall Street's past and truly grasp the forces that have shaped financial markets over generations, 50 Years in Wall Street by Henry Clews is an unparalleled resource. These fundamental, richly illustrated memoirs, presented in 2 volumes, cover half a century of Wall Street history, from the tumultuous panic of 1857 right through to the excesses of the Gilded Age. The book offers unique accounts of financial titans, intricate market manipulations, and invaluable insider perspectives on pivotal economic events. It's an essential read for anyone seeking a comprehensive understanding of the historical context that underpins today's financial world. Discover this monumental work and enrich your market knowledge by clicking the link in the description.